All right, today we're going to talk about what is the stock market and how does it work. Now, this is truly, truly important, so we're going to navigate through this space like only Trap can do, right? And I know a lot of people really want to get into the market. You really ready to start getting investing, but I'm going to be honest with you. I can't even let you get in the market if you don't really know what it is. Of course, you have an idea, but you don't really know how it works. So it's my goal, my job to help you understand how this thing truly works. And just like that, the stock market was going off on my phone, and we not gonna edit that. So I gotta get into it first, right? So the stock market is a place where buyers and sellers come together to find a price agreement on a stock. Now, we already talked about what stocks were, right? It's a portion of a company that you get to buy and take full ownership of. Now, the stock market does have three indices, right? So you have the S&P 500, which is your 500 biggest stocks. And then you have the NASDAQ, which is 100 of the more innovative stocks. And then you have the Dow Jones Industrial Average. So the Dow Jones Industrial Average consists of companies like your Caterpillar, your John Deere, the industrial companies that make up the fabric of America. But we're gonna dig a little deeper. We're gonna dig a little deeper into this. So the NASDAQ has about a $23 trillion market cap, right? Remember, this is your high-flying tech stocks, right? And then your Dow Jones has about a $40 billion market cap. Now, the dope part about this is the stock market does have rules, right? And those rules allow it to be governed by an entity called the SEC, right? The Security Exchange Commission. Now, their goal is to make sure that everybody playing on the same playing field, right? Because without rules, people gonna do whatever they won't do. People going rogue. It's definitely gonna be a crazy thing going on right here. Right now, the first exchange ever was the London Stock Exchange. The first exchange in America happened in Philadelphia about 1790. Now, what happened was these guys had an idea that in order to give people the opportunity to grow with the country, the best thing to do was allow them to have shares in companies. Of course, it was a good old boy thing, right? Where it was only for the upper echelon. It was for the elite. Now, I want you to think about something. I remember watching this movie called The Men Who Made America. And it blew my mind because Cornelius Vanderbilt was one of the richest men in the world. I think, if I'm not mistaken, he was probably the first billionaire, right? Cornelius Vanderbilt had an idea. So Cornelius Vanderbilt is responsible for the railroads that we have, right? So at one time it was a big war with the Vanderbilts, the Rockefellers, Dale Carnegie, J.P. Morgan Chase. And I remember in this documentary, it was kind of like a buyout, right? Where all of his competitors were preying on his downfall, but Cornelius Vanderbilt had the train that ran through New York. He put a dead end or something, a blockage, a roadblock, where the trains couldn't go through. It caused his competitors' stock to fall because he had the gateway to go through that side. And what happened was they was trying to force him out. So he said, all right, y'all want to force me out? I got something for y'all. And so when all their stock fell, he went and bought all of their stock and became the sole owner of all the railroads in America. He became the sole owner of those stocks. He owned more than 51%. And then once he took sole ownership of the companies, he lifted the barricade, let the trains go through, and that's what made him the richest man in America. That was crazy when I saw that. But it also lets you understand the power of the stock market. So again, how does it work? You are, as an individual, or they will call us retail investors, you have the opportunity to buy shares in companies. Now, there's three things I want you to understand about the stock market. There's three very important people we got to understand. One is the market maker. Two is the investor. Three is the trader. These are three different identities that are on the stock market. The market makers are your people who work inside of the exchanges, and what they do is they play two sides of the coin. In the street, we say they play both sides of the field. So what they do is they create what's called a buy or a bid price and a ask price, right? They create a bid price and they create the ask price. And when they create that, they are the middleman between two people who are going to decide how a stock moves. They get paid on what's called the bid-ask spread. So if the buy person has this, if the bid person has a price, the ask person has a price, the person in the middle, the market maker, is a seller, right? He makes sure the deal get done, and he gets paid from that spread in between. So again, let's say the bid person says $1.50, the ask person says $1, and they decide on that. They decide on selling it for the dollar, whatever. That middle price, what they agree on, that is what the market maker gets his money from. They don't care if you buying or selling as long as you have some type of activity, because the market maker wants to get paid from your activity. Next, you have the investor. Now, these may be some of your big companies, right? They're the people who are putting money in the market, and they are looking for a financial return on that investment. These are the people who buy companies, and they are creating like your 401ks. They're the people creating your retirements. There can be people managing your portfolio. They're looking to make money over a long period of time, right? So this is why you have wealth management companies. This is why you have what we call hedge funds, mutual funds. These are the investors. And then you have a third identity, which is the traders. So the traders aren't looking to hold on to companies for long periods of times. They're often looking forward to making money on some type of momentum or a stock going either way. It is possible for an investor to also be a trader. It is possible for an investor to also be a trader. So I'm telling you this because I need you to understand how this game is being played. Because once you understand how the game is being played, you can then play the game at a high level. Now, in order for companies to get on the stock market, what do they have to do? They have to do what's called an IPO, which is what? An initial public offering. This is when a company says, you know what? I don't want to go in debt with the bank. So you allow your company to go on the market, and then you're allowed to sell shares of your company to individuals. And then your goal is to take that money and do what with it? Build and expand your business. Now, another thing I want to talk about when it comes to the stock market is regulation. Now, we talk about the rules that have to be abided by. When we think about insider trading, so people always have the wrong concept and the wrong idea about insider trading. So insider trading is not a CEO of a company selling his shares. That's illegal. The insider trading that's illegal is when the CEO tells somebody else some news about why he's selling his shares because he feels like something is about to happen, and boom, now you cause a chain reaction. That is illegal. Like also having some information about a company and then giving that information to someone so they can buy or sell shares. That is illegal. But me being a CEO of a company and me selling my shares, that type of insider trading is legal. So I want y'all to stop panicking when y'all see or hear something like that. So I'm glad we talked about the IPO, because here's something I really want you to know. There's also two different sets of markets. There's the primary market, and then there's the secondary market. The primary market is when a company goes IPO. This is when your banks, the government, large financing groups, they can get companies through debt-based financing or equity-based financing. This is when when companies can issue out their IPO shares to again finance the company. This is when everything is sold through IPO, and so often you hear people say they're in a lockout phase. That's the primary market. I ain't gonna lie to you. That's when you won't get in the game. That's a whole different ball game if you can get in the primary market. So The primary market is where you get new stocks, new bonds for first time issuance, right? This includes IPOs, private placement, and rights to issue. That's something else we'll get into. So the primary market is where the shares initially go to when you have the idea that you want to go up and be a public company. Also, this is where your banks do the underwriting at, right? When they give your company an actual evaluation, they tell you what the shares going to cost. That is the primary markets. The secondary market, people often get confused. This is the NASDAQ and the New York Stock Exchange, right? That's not the primary market. That's the secondary market. That is where the shares get buy and sold through traders and investors like us. This is where we get in as the public. I'm gonna say it again. The secondary market is when we as the public can get in. We can buy, sell, we can trade. This is when all that happens. This is when your market makers come in. None of that happens in the primary market. Everything, all of that happens in the secondary market. And that is where we get at. Now, if we want to get in that primary market, then you got to get into, investing in startups, being accredited investors, things like that happen. But the primary market is definitely also where massive wealth is attained. I'm not gonna lie. This is when Kobe and Nas, this is when they got in those companies early before the Jay-Z got in Uber. All these people get in these companies before they go public. I'm not gonna lie to you. That's it. That's how you become 9 figures. That's how you go invest like $1 million in a startup company. You get in a primary. Now I'm gonna be real with you. You got to know somebody to get in that market. It ain't easy to get in because they know this the billionaires club. This how you become worth 9 and 10 figures right here. But let's get back to what we were talking about. So we talked about IPOs. We talked about primary markets. We talked about secondary markets. These things are important for you to know. Now, how does the stock market work? The stock now has to be put on the exchange. I have to say where it's going. But also there's the Russell 2000, right, which is your smaller cap companies. The stock now gets placed somewhere. There's also the Chicago Stock Exchange. I almost forgot to talk about that. The Chicago Stock Exchange is not well known. It's about a $50 billion market, but they do a lot of ESG, clean investing, things like that. But your main ones are going to be the S&P, the NASDAQ, the Dow Jones. So now the company is placed on an exchange. Once it's placed on the exchange, now the company's goal is to provide value. As the company continues to provide value, investors like myself now say we want to buy this. Once we say we want to buy that stock, the market maker comes in and say, okay, Wall Street Travel wants to buy 100 shares of XO dog food. He wants to buy it for $198. He goes and buys for $198. Somebody say, yep, I'll sell it to him for $198.75. The market maker takes that split from the middle. I now get 100 shares. So I want you to know this. Every time you go to buy a stock, someone on the other side is selling you that stock to a market maker, and then you get it. So you don't just press buy and then it's gone. You have to press buy, and it has to find somebody who's selling those shares to you. This is why liquidity is important, because if trading, this is going to be important. If you're trading, this is why your open interest is important, because if a company if that stock price has low open interest, you'll see your trade get stuck in the queue. It'll say, we've placed your order and nobody ain't bought it yet. Understand that buying and selling stocks, there always have to be a buyer and a seller in order for that stock to go. Now, here's the next thing. Good news and bad news can make stocks go up and down. Investor emotion, or how a person thinks something is going to happen, because the stock market is a forward-looking mechanism. So how a person thinks about this stock in the future is how it responds today. How a person thinks that a stock is going to move in the future is how it responds today. There's bears. Bears are typically investors who are bullish. meaning they think the stock is gonna go down. And then there's bulls. Bulls are optimistic. They feel like there's always a reason why the stock market can go up. Bulls often have opportunities where they can take profit. Now, taking profit can also cause the stock market to go down. So after the stock market goes up for a long period of time, people start to take profit, and that can cause the stock to go down, because as you sell shares back to the market, the stock goes down. As you buy shares of stock, that means less shares of that company is on the market, and that causes the stock to go up. That is supply and demand. Oh my God, I hope y'all enjoying this right now. Okay, let's rewind that a little, because I think you need to hit that again. Fear is when people are selling stock. They're getting rid of it. They want to get their cash. Greed is when people are buying stock. That means people want to own it. The more people want to own something, guess what happens? The stock goes up. So the more people want to own it, the more value that this company is bringing, or the more optimistic people are about the future of a stock, the more it goes up. Now, you don't have to be a bear, but even bulls find price points where they feel like, you know what? This stock is what's called overbought, meaning a lot of people have bought into it. Let me take some profits to put it on the side. Once the bulls start taking profits, the stock starts to come back down. As an investor, that is not the time for you to panic. I want you to know that. This provides buying opportunities. So remember this, there's bulls, there's bears. There's market makers, there's traders, and there are investors. All of those people play a role in how the stock market moves. And then you have the whales. And so the whales are a combination of investors and traders who are now putting millions and billions of dollars into companies, and the stock goes up, and millions and billions of dollars they're selling, the stocks go down. Man, this is a great video. I truly hope you enjoy this video. I want you to like, I want you to comment, I want you to share this, because once you understand how this market moves and what makes the market move, you will truly, truly, truly be on your way to making a lot of money. It's your boy, the Wall Street Trapper. Make sure you, again, like and subscribe, comment in the chat, tell us the type of content that you want from us when it comes to this, but also check out our show, Trapping Tuesdays, each and every Tuesday at 7 p.m. Eastern Time on the Wall Street Looks Like Us Now network. It's your boy, the Wall Street Trapper. Salute.